The price-to-earnings ratio, or PE ratio, is a valuation metric for stocks. It is one of the most commonly used tools by investors to assess the value of a company's stock. It tells you how much investors are willing to pay for every dollar of a company's earnings. Essentially, it's a way to measure what the market thinks about a company's future growth prospects. Think of it like this. If you were buying a business, the PE ratio would tell you how many years it would take to earn back your initial investment, assuming current earnings stay the same. For example, a PE ratio of 15 means it would take 15 years to recoup your investment. A high PE ratio suggests that investors are willing to pay a premium for a company's stock. This could be because they expect the company to grow quickly in the future, or because they believe the company has a competitive advantage that will sustain its earnings. This could be because they expect the company to grow quickly in the future. High PE ratios are often seen in industries with high growth potential, such as technology or biotechnology. A low PE ratio, on the other hand, suggests that investors are not as optimistic about the company's future prospects. This could be due to various reasons, such as declining sales, increased competition, or economic downturns. The PE ratio is just one of many tools that investors use to evaluate stocks. It's important to look at other metrics and indicators to get a complete picture of a company's financial health and potential. It's important to consider other factors, like a company's debt levels, management team, and competitive landscape before making any investment decisions. For instance, a company with a high PE ratio but also high debt levels might be riskier than it appears. However, the PE ratio can be a helpful starting point for comparing different stocks. It allows investors to quickly gauge how a stock is valued relative to its peers. It can give you a general idea of whether a stock is overvalued or undervalued. By comparing the PE ratios of similar companies, you can identify potential investment opportunities or risks. Remember, no single metric should be used in isolation. The PE ratio is a useful tool, but it should be part of a broader analysis that includes other financial ratios, market conditions, and individual company factors. By combining the PE ratio with other information, you can make more informed investment decisions and build a diversified portfolio that aligns with your financial goals. Calculating the PE ratio is relatively straightforward. Simply divide the current market price of a company's stock by its earnings per share, EPS. The formula is PE ratio equals market price per share divided by earnings per share. For example, let's say company XYZ is trading at $50 per share and has earnings per share of $5. Its PE ratio would be PE ratio equals 50 divided by 5, which equals 10. This means that investors are willing to pay $10 for every $1 of earnings that company XYZ generates. Seems simple, right? Well, it is. But understanding what this number actually means takes a bit more digging. Don't worry, we'll delve deeper into interpreting and utilizing this ratio in the following sections. Let's look at some real-world examples to solidify our understanding of the PE ratio. Imagine you're considering investing in two companies, Company A, a well-established tech giant, and Company B, a rapidly growing startup in the renewable energy sector. Company A has a current stock price of $200 per share and earnings per share of $10. This gives it a PE ratio of 20. 200 divided by 10 equals 20. Investors are willing to pay a premium for Company A, perhaps due to its consistent profitability and strong market position. Company B, on the other hand, trades at $50 per share but only has earnings per share of $1, resulting in a PE ratio of 50. 50 divided by 1 equals 50. This high PE ratio indicates that investors have high expectations for Company B's future growth, despite its currently low earnings. Section 4. Forward PE versus trailing PE. A look ahead and behind. In this section, we will delve deeper into the nuances of these two important financial metrics and understand their implications for investors. So far, we've focused on the trailing PE ratio, which uses a company's past earnings to calculate the ratio. This metric is derived from the actual earnings reported by the company over the previous 12 months. However, there's also the forward PE ratio, which utilizes analysts' estimates of a company's future earnings. This forward-looking metric is based on projections and forecasts, making it inherently more speculative. The trailing PE ratio is a more concrete figure based on historical data. It provides a snapshot of how the market has valued the company based on its actual performance. It tells us how the market has valued the company based on its past performance. This can be particularly useful for understanding how the company has been perceived historically by investors. This is useful for understanding a company's historical valuation. By looking at the trailing PE ratio, investors can gauge how the company has performed in the past and how it has been valued by the market. The forward PE ratio, as its name suggests, looks ahead. It is based on estimated future earnings, which can provide insights into the company's potential growth and future performance. It uses estimated future earnings to project the company's future valuation. This can be particularly helpful for investors who are looking to understand the growth prospects of a company and how it might perform in the future. This can be helpful for gauging market sentiment about a company's growth prospects. By analyzing the forward PE ratio, investors can get a sense of how optimistic or pessimistic the market is about the company's future. It's important to remember that future earnings are just estimates and can be inaccurate. These projections are based on various assumptions and can be influenced by numerous factors, including market conditions and company performance. Therefore, the forward PE ratio should be taken with a grain of salt and used in conjunction with other metrics. Investors should consider both the trailing and forward PE ratios, along with other financial indicators, to make well-informed investment decisions. Section 5. Understanding the limitations of PE ratios. While the PE ratio can be a helpful tool, it's important to remember its inherent limitations. Firstly, the PE ratio doesn't account for a company's debt. A company with a high debt load might appear cheaper based on its PE ratio, but it actually carries more financial risk. Secondly, the PE ratio can be influenced by one-time events or accounting anomalies that don't reflect the true earnings power of a business. Always investigate unusual fluctuations in earnings carefully. Thirdly, different industries have different average PE ratios. A PE ratio that's considered high in one industry might be considered low in another. Therefore, it's crucial to consider these limitations and use the PE ratio in conjunction with other financial metrics for a comprehensive analysis. Section 6. Comparing companies within an industry. One of the most valuable uses of the PE ratio is to compare companies within the same industry. Since companies in the same industry face similar economic conditions and customer bases, their PE ratios can provide a meaningful basis for comparison. For example, let's compare two grocery store chains, Company C and Company D. Company C has a PE ratio of 15, while Company D has a PE ratio of 18. This suggests that investors are willing to pay a higher premium for each dollar of earnings generated by Company D. This difference in PE ratios could be attributed to several factors, such as stronger brand recognition, better management, or higher growth potential for Company D. However, it's essential to investigate further to understand the reasons behind the difference in valuation. Section 7. The importance of using multiple financial metrics. While the PE ratio can be a useful starting point for evaluating stocks, it should never be the only factor you consider. The PE ratio, or price-to-earnings ratio, gives you a snapshot of what the market is willing to pay today for a stock based on its past or future earnings. However, relying solely on this metric can be misleading. It's crucial to use multiple financial metrics in conjunction with the PE ratio to get a comprehensive picture of a company's financial health and future prospects. Each metric provides a different perspective, and together, they can help you make a more informed decision. For instance, while the PE ratio might indicate a stock is undervalued, other metrics might reveal underlying issues. Some other important financial metrics to consider include price-to-book, PB ratio. This ratio compares a company's market capitalization to its book value, which is the value of its assets minus its liabilities. A low P/B ratio might indicate that a stock is undervalued, but it could also suggest potential problems with the company's fundamentals. Debt-to-equity ratio. This ratio measures a company's leverage, or how much debt it uses to finance its assets. A high debt-to-equity ratio can indicate that a company is aggressively financing its growth with debt, which can be risky if not managed properly. Return on equity, ROE. This ratio measures a company's profitability by calculating how much profit it generates with the money shareholders have invested. A high ROE indicates that the company is efficient at generating profits from its equity financing. By considering multiple financial metrics, you can gain a more complete understanding of a company's financial health and make more informed investment decisions. Each metric has its strengths and weaknesses, and together they provide a balanced view of the company's performance. Remember, investing is like putting together a puzzle. You need all the pieces to see the complete picture. Each financial metric is a piece of that puzzle, and only by considering them all can you truly understand the full story of a company's financial health and potential for future growth.